I'm Ashley Redmond from Morningstar.ca, and it's Global Diversification Week here at Morningstar Canada. I'm joined by Paul Musson, lead manager of the $3.5 billion Mackenzie Ivy Foreign Equity Fund and Morningstar's 2011 Foreign Equity Fund Manager of the Year. Paul, thanks so much for joining me.
Well, thank you.
So, as I just mentioned, it's Global Diversification Week here at Morningstar Canada. And looking at Mackenzie Ivy Foreign Equity, you have about 3.1% of your portfolio weight in Canadian equities, which makes sense because it's a foreign equity fund. But overall, looking at the funds that you manage and co-manage at Mackenzie, it looks like you really don't have a home bias. So is it part of your strategy to have exposure to foreign stocks?
Well, yes and no. I mean, it is a global fund, obviously, but we try not to have any bias anywhere. You know, in anything we do, we try to be as objective as we possibly can be, because only by being objective, you know, can we make the best capital allocation decision with our clients' capital. And that goes in terms of not being optimistic or pessimistic, not bullish or bearish, but realistic. But the trouble is, we sort of joke, when you're realistic and everyone else around you is optimistic, on a relative basis you come across as being pessimistic, right? But that's a sort of a side note. But in terms of Canada, 3% right now, but it's purely a bottom-up. And it's a global opportunity set, and we look for high-quality, world-class businesses that are reasonably priced. And right now, 3% Canada is telling us where we should be, our valuation models. And one day it may be higher, one day it may be zero. Okay. But it will never be significantly higher.
Okay, and at Mackenzie, it seems that you run concentrated portfolios of 20 to 30 companies. So how do you ensure proper diversification?
So one of the benefits of having a very concentrated portfolio is you pretty much know what you have at all times, and you know where your exposures are, if you will. Having said that, it really is again, because it's a pure bottom-up, we look at diversification more from a business risk perspective than a sector perspective. And what I mean by that is we usually are overweight consumer staples, consumer discretionary, but we're not concerned about that. We're not concerned about that risk from a 10-year perspective. For instance, if we have yogurt through Danone in France, and we have toothpaste through Colgate in New York. So they're both consumer staples, but we're not concerned about that overlap. We have Sonova, which is a hearing aid manufacturer in Switzerland. We would not want to put another hearing aid manufacturer in there because that is specific business risk from a 10-year perspective, because if someone comes up with a cure for hearing loss, then both those companies are in big trouble. So that's the way we look at diversification.
So this sort of relates to my next question, because I wanted to know what's your approach to sector allocation? Again,
it's purely bottom-up, so and more from a business risk perspective, and then we just let our valuation models take us where we should be going, and so sometimes we're going to be overweight defensive type names, things like consumer staples and healthcare. Other times we're going to be overweight more economically sensitive names like financials and industrials. And we were 70% economically sensitive names back in 2000, going into the bear market, yet we outperformed. The fund was more or less flat through that bear market, despite being 70% economically sensitive, because that's where the valuations told us to go. Before the financial crisis, we were up to 70% defensive names. Again, outperformed during that crisis, but our economically sensitive names outperformed the defensive names because they were very cheap. And today we're back down to about 60% economically sensitive, 40% defensive. So we try not to have a preconceived notion as to where we should be based on what we think the world is going to do. It's where evaluation is telling us we should be.
Okay. And one thing we're talking a lot about this week is currency hedging. To hedge or not to hedge. So what's your take on currency hedging?
Yeah, well, the way we've dealt with it is just by having one of each. So we have a fund that's non-hedged, which is the main fund, but we also have a hedged version. And so we pretty much leave it up to the advisors to decide what they're comfortable with. The one thing we do say is that, being unhedged, there is a risk there. Now, there's global diversification in currency exposure and whatnot, so you're somewhat protected that way, and as diversification if you've got Canadian assets. However, if the Canadian dollar appreciates significantly for the next 5 to 10 years, you're going to be hurt by not being hedged, right? We're not sure that there's any structural reason why the Canadian dollar should appreciate significantly versus other currencies around the world. You can always make a case for and against. But it doesn't mean it won't happen. So if you have a 5-year or less time horizon, then you might want to consider the hedged version just so you're not offside on that currency exposure. If you're longer than 5 terms, I'm not sure I would worry about it too much, but it doesn't mean it won't hurt you.
Okay. And my last question for you, I was taking a look at Mackenzie IV foreign equity, and it looks like you're holding a lot of cash right now. So why is that?
Again, it's because of our valuation models. The way we do it for all of our businesses, we have our proprietary valuation models, and we have an expected return for each of our holdings over the next 10 years. And the higher the expected return, the higher the weight that stock will be in the portfolio. And as the return keeps, if the stock is going up faster than the business, so the expected return is coming down, we keep reducing the weight. And once it's lower than a 6% expected return over 10 years, it leaves the portfolio because there's not enough margin of safety in the valuation. And so where we are today, a lot of our, well, not just our names, but high quality stocks around the world we think have gotten quite pricey. And thus the cash weighting has gone up because we're having, a lot of our names have reduced in size because they got more expensive or left the portfolio, and it's harder to find other names out there that are cheap enough to put in. So our expected return on our portfolio now is between 8 and 9% per annum over the next 10 years, which is okay, but it's not great. And that's why we have a cash weighting today.
Great. Thanks so much, Paul.
You're welcome.
For more on Diversification Week, check back at morningstar.ca.